All right. Hello, everybody, and welcome to Selfwealth Live, our technical analysis edition this week with Jason McIntosh of Motion Trader and Roger Ruziev from Selfwealth, obviously. How are you, Jason? How are you this week?
Hey, Rog, I am good. Good to be back in the show to talk about some more stocks and how the markets are going. So plenty of interesting stuff going on at the moment.
Yeah, I think there is. How are you feeling compared to last week? I think the voice is still a little bit, it's getting better, I can see, just like the share market.
It's getting better, but I'm not quite there. It's bugger of thing when you get a little bit off. So maybe there'll be the odd cough or something through this. Hopefully we'll be pretty much good to go.
All right, fantastic. Welcome everybody for coming along. Thank you for coming along. Much appreciated. Always week on, week off. It was great seeing some new people put their comments in chat as well and ask some questions. Before we get to the most exciting part, which is the disclaimer, as you know, what we'll do is we'll go through the markets. The ASX, the US markets, and the Hong Kong Hang Seng market. And if you want us to have a look at another international market, we can have a look at that as well. Then we'll just go through general comments and questions. And I've got one that was raised from last week, which I think is a good topic. We can jump on straight away. And then if there's any tickers you guys want us to look at, we can look at those as well. But without further ado, Jace, do you mind sharing our disclaimers, please?
Yeah, quick disclaimer. Everything today is general commentary only. No personal advice is given. And if I just pop this disclaimer up, that just goes through all of that. The other important point is I'm from Motion Trader. I'm not part of Selfwealth. So you'll see all my details in the top section, licensing, etc. Selfwealth is below that, all Selfwealth's details. So again, it's just general commentary only.
Beautiful. And if you really want to read that, it'll be underneath the video as well. Okay. Jace, this week, it seems like the markets are starting to turn up. It doesn't mean we should get too excited. Do you want to tell us a little bit about the ASX then? Do you want to get onto it?
Yeah. So let's have excuse me. Let's have a look at the ASX 200. And you're right. A few up days doesn't mean, of course, never. A few days in either direction doesn't create a trend. It's everything else when you put it all together. That's what we'll look at now to try and work out where all those pieces come together. And look, hasn't this been an extraordinary period? So at the start of the month, the ASX 200 has one of the quickest falls from an all-time high that we've ever seen. And lots of people bracing for the worst. Lots of talk of recession started to come into the media after a 3-day sell-off. And now here we are, just 2 weeks later, and the ASX 200 is within 2% of an all-time high. So all except for this initial portion of day one of the sell-off has been erased. All that fear that quickly took over has almost entirely disappeared. So it just shows how quickly things can swing around. The most interesting thing, I think, of all this really is that throughout all this, the structure never turned bearish. So we had all the fear, all the uncertainty certainly increased, but the structure never actually turned bearish. And I think this is why we're better served by trying to act as much as we can off a plan rather than getting sucked into the headlines and doing things just because things get scary. So, I've got a plan, but I'm scared, so I'm just going to sell. I think when we do that, then it really does become very hard. I think having those plans, I think it just helps dial down the emotion and helps keep that decision making as objective as it can be. This is looking at this now. This is a really interesting price structure we have. So just looking at how this has all worked out. So I've lost a couple of lines have come off my chart, but previously we'd been talking about this breakout from this range, and beneath the range they had We had there was some support below the range. And so we basically had a range. The market had traded for 3 months. We had a breakout to the top side. And from there, it all came apart rapidly. So we were left with a false break to the top side. So that's a classic warning sign. It's a classic warning sign when you get a false break. Then we had the sharp sell-off, but the sharp sell-off didn't attract follow-through selling. And now we have a V-shaped recovery. So we've got all sorts of stuff going on. This is what makes the structure so interesting. So I think when we weigh all this up, we have a market that wasn't able to sustain a break higher, but it was still attracting strong buying interest after the sell-off, which is evidenced by that strong V-shaped recovery. So I think on balance, when we put all this together, I think we still have a structurally bullish market that isn't ready to resume the underlying uptrend. So the opportunity to resume the uptrend was in place last month into the beginning of this month. Wasn't able to go on with it. But it hasn't structurally turned bearish, and there's a lot of and strong buying interest on the dip. So overall, that's why I say on balance, I think that structurally bullish picture remains intact. But in the near term, I think it probably means that we're in for more consolidation, more chop, more of that back and forth price action as we experienced in earlier months of this year. Just maybe within a broader range, until the market is ready to potentially then resume the upward trend maybe later in the year. I think the play here, I think the play here is still being long stocks. That hasn't changed all year. I was talking about using the rally off the lows potentially to de-risk a portfolio. So by that, it was all about considering getting out of some stocks that maybe had been underperforming, or perhaps even skimming some profit off some big gains. I've done both of those things during the rebound. It's just really tapping at the edges of my portfolio rather than making massive changes. And the reason for all that was that the sell-off did open a window of vulnerability. So that's when price was below these moving averages. We've got the 50 and the 100-day moving averages. When you get price below the moving averages, it sets up the potential for a structural change where price then starts to consolidate below the averages. And when it's consolidating below the averages, it opens the vulnerability of a breakdown. So that's why I was saying maybe using that rally as an opportunity to de-risk a portfolio to some extent. And we had the added concern of the false break. So that added in an extra variable, which suggested that, look, there is some risk with this. So that seemed like a reasonable play. In hindsight, look, maybe it would have been better not de-risking a portfolio, but you don't know. We can't play in hindsight. We deal with what we have. And I think my feeling is at the moment is that I don't think we're going to see a new all-time high in the next few weeks. As I was saying, rather, I think it's a case that the ASX 200 maybe comes back to these moving averages, maybe needs to do a bit more work before we can then look at another opportunity to break higher. But look, it's interesting. It's really interesting price action to watch here.
Yeah. So, I mean, looking at your chart there, it literally just bounced right off that previous support area. Which if you knew you're looking at, you would be looking really interestingly at that area, right? Now it's done this. What's that?
Sorry. Yeah. I've for some reason today my chart hasn't opened up with the lines I've had drawn on. This isn't exactly where I've had it in the past. I've just quickly put something in. I think the support I was looking at might have been a little bit different. I don't know. I have to check where. Yeah, but look, you can definitely say when you look at this, there is some support around this area, which it came back to. This is a different line to what I've used previously. Just the fun of when you do these things, you open up a chart. Sometimes the technology doesn't give you all your pre-inserted information back.
It's good to just look at that most recent history though, and seeing where you think that it might go back to, which it did in this case, and then just rebounded back through this range now, starting to go up. So that said, I remember last week you were saying you're probably not going as hard with your buying. You're de-risking your portfolio. Are you now a bit more positive and putting more? You're going to be putting more trades in the market if the signal's right for the company.
Yeah, it's one of the things I've said in the last couple of weeks is like just waiting for the right setups. When the right setups are there, it's I'm happy to go with them. And de-risking is not so much a case of just saying, well, like I just want to square up and get out of the market. As I've said, it's a case of de-risking is saying, okay, I'm going to be a little bit less patient with a few of these stocks which have been underperforming, just in case the structure does continue to deteriorate. And it's sort of like a micro adjustment within a portfolio. You just sometimes you want to like tap on the accelerator a bit. Sometimes you tap on the brakes a little bit, but whilst keeping those the core principles of your trading plan and what you do intact. But yeah, it's just tapping around the edges.
All right. Well, maybe because the reason why I asked that question, I think, is based off before we get on to the American market, we might just take a bit of a route down the general question you was asked last week, which I thought was a good question. I just thought it was probably a longer answer, and we probably didn't have that time last week, right? So, so the question was: should one suspend their trading plan because of the position of the general market, or should they follow the trading plan regardless of the general market? I think that's the question in a nutshell.
Well, it's it's an interesting question, and because like a market filter can be part of a rules-based trading plan. So if your trading plan says a signal is void if the ASX 200 is below its 50-day moving average, that's a potential part of a systemized plan. In which case you might say, look, I've got buy signals, but my system says don't buy if the ASX 200 is below the 50-day moving average. So in that case, that would be a completely normal thing to do. You'd be following your plan. I've actually done some testing on market filters, and I didn't find they added much value to what I'm doing with the process that I apply. I found that I was getting some good signals during periods when the ASX 200 may have been below its 50-day moving average. I think when I back tested out over time, I don't think it made a huge difference either way, but it wasn't adding value. And for me, to add in a rule, it has to clearly add value. Otherwise, it just adds complexity for the sake of complexity. So it doesn't go in. So I don't use a market filter. So the core of my portfolio is going to be signals based without a filter. But one of the things I do, I sometimes, and this is what I've been talking about the last few weeks, I sometimes play around the edges with, I guess you'd call it a discretionary filter. So it's like, I guess a discretionary filter is not a formal part of a trading plan, which builds my core portfolio, but it's, if I see things like false breaks and rapid sell-offs, it's I'm inclined to be maybe slower to take buy signals when they're coming up, and more prone to be less patient with some underperforming stocks, as we've been speaking about. Over time, when I look at over time, would I be? This is interesting too, because over time, if I look at what if I'd actually followed every rule to the letter, I'd actually be better off than had I played around the edges. It's so even knowing that, I just can't help myself sometimes to play around the edges. I think it's a very human trait that we see the potential to tweak something for the better. It's very hard to sometimes resist that urge to do so. So I think in being successful with using a system, I think we need to have awareness and we have to have discipline. We need to have the awareness when we come off the rails a bit, when we start to just move away from our plan, and then we've got to have the discipline to get back on the rails. So I'm good at that. I'm good with the awareness and discipline. So I know when I stray from the rails a little bit, and I can get myself back on the rails, and without like when you start getting sell-offs like we've had in the last few weeks, and you just panic and go, okay, forget the rules, I'm getting out. That's when the whole thing doesn't work. It's about, you've got to be able to like, and the thing with being able to follow rules is that sometimes you've got to reduce the stakes a little bit to make it easier to follow the rules. So by a discretionary de-risk can actually make it more emotionally palatable for you to follow your rules, because you just take the stakes down a notch, and now you find, look, I can now actually keep following my trading plan, whereas before I was getting flustered, the market was coming off, it was getting really hard, I thought maybe I wanted to sell everything, but I've de-risked, now I'm okay, now I can follow that plan. So we're not robotic. It's very difficult, I think, for most people, if not almost everyone, to just always be 100% to the letter on everything that their trading plan says they should do. And having a little bit of flexibility, if it can help you keep the overriding principles intact most of the time, I think that's probably a reason why, yeah, sometimes it can pay to be able to just have that ability to understand when you do need to make an adjustment to a plan to make it work for you.
Yeah, look, that's a great response at the end of the day. Like you said, we're not robotic. I think we've got to accept that, and having that experience that you have, that you can impart in terms of talking about looking at false breaks and seeing when the market plunges that much, not to panic, and just see if it gets down to that next support level, and if it breaks past that. All these things are great bits of knowledge that we can just take in and use as part of a discretionary, discretionally part of the plan of your plan, right? So I think it's really good.
We don't want to be infusing too much discretion in our plan. I don't want to send that message, because it's not what I do. What I do is I don't know, like, I'm 90% on target, and maybe 10% I play around the edges. It's not about saying, oh, look, I've got these rules, but today I'm going to go do something different. I'll buy a stock which is below its moving averages. Just got some gut feel on it. That's you don't have a plan when you're doing that. You're just doing everything. That's not what I'm saying. It's about it's not about saying, oh, look, I'm going to let this stop loss fly because it's I'm pretty sure this one's going to come back, so I'll just take the stop loss off this one. Then you don't have a plan, because it's a sometimes plan. It doesn't work. It's not a plan. Mm-hmm. But when you do things like saying, I recognize a false break, and I recognize the vulnerability that adds to a situation, and I can see where moving averages are, that price is below averages. I can see risk. So maybe as price reverts to the mean, as it often does after a sharp sell-off, you get that knee-jerk reaction. Maybe it makes sense to take a bit of risk off the table, because then maybe you're better placed to be able to follow your plan overall better with the bulk of your capital, just by trimming the sails a little bit. Everything else becomes easier to stick with, because like a trading plan's great, but if you can't follow it most of the time, it doesn't work. Anyone can follow a trading plan when they're making money, but you got to make it so your plan's followable when times get tough. And I think the best way to be able to follow a plan when time gets tough is that you turn the volume down a little bit. So you're still watching the program, but you just turn the volume down a notch. So you've taken the risk out of it, you've taken the heat out of it, and now you can stay the course. Whereas before, like going, I'm locked in 100%, I'm doing everything it says, until it gets to the point where you mentally can't stand it anymore and you stop playing. And that's when you can look back with a lot of regret later on, when you go, well, if I'd been able to stay in the game, even at a reduced risk level, it all would have worked out. But I got taken out by the emotional extremes at a certain point in the cycle.
Yeah, no, look, I think I like your analogy more around the acceleration, deceleration thing. So rather than going, you're following the plan, going straight, rather than taking a hard right. If you're breaking the rules, taking a hard right, you're not going to end up to your goal. You veer off a little to the right, you slow down, and then you get back on track going straight, right? But then, as Kirby's another one of his great wisdoms here, from not from him, but from Ed Sakota, he is know when to break the rules. So as in going straight, break, slow down, break, and then just reassess the situation before you keep on moving forward, because that could make you end up crash as well. Love these analogies. It's fantastic, right? So, all right, well, that's good. Great wisdom, Jason. Let's have a look at the US markets, please. Is that going to plan?
Right, US, S&P 500. And, well, excuse me. Well, hasn't this been extraordinary? So this has been a huge turnaround. S&P 500 and the Nasdaq. So both those big indices, they've had 8 up days in a row. Now that's the longest winning streak this year, and it all comes off the back of all the upheaval we had a couple of weeks ago. So last week I was saying that I was concerned that the rally off the low wasn't showing a lot of vigor. So just having a closer look at it, you can see how we had 3 quick down days, and then we had 5 or 6 days which barely recouped the losses from one of the down days. So that was a concern last week, that there wasn't a whole lot of vigor in that price action, and that opened up the vulnerability for prices to stall below the moving averages. And so this is a sort of scenario which I was concerned about, that we got price action like such, and the moving averages continued to roll over. When you get that setup, then that opens a risk that you get the sharp decline from there. Of course, that price action didn't eventuate, and I wasn't suggesting that price action would eventuate. It was like, that's what we've got to look out for. That becomes the danger. We have price below the averages, and prices aren't really making much headway. But no sooner had we discussed that, prices quickly broke above this resistance. We spoke about this last week. There was a resistance point, and it was a case that we said that if prices break above that resistance, well, then that would then neutralize the vulnerability, and that's of course what's happened. Vulnerability neutralized, and that sell cycle that was triggered a couple of weeks ago was pretty much broken from there. So where are we now? Well, S&P 500 rapidly closing in on this new on a new all-time high. It's actually a really rare event for the S&P 500 to quickly fall 10% from an all-time high. So this was an all-time high. Market quickly lost 10%. So it's a rare event for after that the market then snaps back and then rallies straight back to an all-time high on its first rebound. So you'd have to say at the moment there hasn't been a pause. This is the first rebound. So I've looked back over a whole stack of data, and there's only one episode or one example of that happening in the last 30 years, and that was back in 2014. So we'll quickly jump back and we'll have a look at it. Back to 2014. It's this period here. So at the time, it was an all-time high. Market quickly lost about 10%. And so you may be wondering what was the big deal back then. It was Ebola. So remember Ebola? That was a concern. Global slowdown. Surprise, surprise. That seems to always be the concern. The fears of a global slowdown, and also the oil price was falling. I think that was all tied in with the global slowdown. So it was a quick unraveling, and then it was just straight back up without pause. But that's only happened once. It's only happened once in 30 years. So this is currently about where we are now on this same. It looks quite similar to what we've just experienced. this is probably where we are now. So are we going to have a repeat of this one incident? I don't know. Time will tell. Close to happening again, although I think my feel is that prices could stall in the near term. I'm wondering if, like, my thinking is whether we see something more like this sort of structure where we do get the quick initial rebound, but then you just get more back and forth within a range before prices ultimately then break to the top side. We see this sort of structure more often where you get a sharp sell-off, a quick recovery, and then the consolidation just drags on for a bit. But look, either way, whether we get a new high in a hurry or whether it takes a bit of time, either way, I think the default position should remain unchanged. And I think that default position is that we should continue to favour the incumbent upward trend, which remains up and has remained up, and that this sell-off didn't change that. The structure never turned bearish. It continued to be a bullish structure, but a bullish structure which had become vulnerable, but nonetheless remained bullish. So that's why that default position remains unchanged. And until we get evidence to the contrary, Rog, I think that's the case. I think it's long stocks, wide trailing stops. Do we make a new all-time high in the near term, or do we get a couple of months chop? Like, September's a weak seasonal month. Seasonally, September isn't a cracker. And October, people always get fearful around October, although October actually has had some of the strongest rallies, often because it's rebounding from an ugly September. So you can't trade your portfolio based off seasonality because it works some years, doesn't work other years. But yeah, when you're in this current situation where we're approaching this all-time high, we've got this volatility in the price action coming into September. Maybe it does bode for that. Maybe it does shift the odds in favour of the pause scenario, and look for highs later on. But either way, I think it's staying long and using that risk management. And this is why we didn't want to panic out all our stocks at the lows, because we've got a strategy for selling. That's the stop loss. And if your stop loss isn't triggered, other than maybe taking a little bit of money off the table sometimes, and we've discussed all that, if your stop loss isn't triggered, you keep your portfolio. And this is why we use those wide stops, so we can see off these bouts of periodic volatility, which do happen.
Yeah, it'd be interesting to see what happens when it gets to, if it gets to that high, if it just struggles, like I said, or just breaks through. But we'll see what happens, right? We never know what's going to happen. All right. What about the Hong Kong? Is that starting to push up as well? Or?
Oh, look, I don't think there's much going on here at the moment. Rebounding off the low, so it breaks that immediate downward momentum that was in place, but I don't think there's much to go off here. I'd just rather leave this one alone. We don't have a dominant trend at this point in time, and the same applies when you go over to China. We've got this bounce off the lows, but it's below these declining moving averages. So, who's to say that we don't get some sideways price action and then another break lower? So it's not the sort of price action I want to get excited about at the moment. I don't think it's price action you can get excited about at the moment. It's just walk away. We'll come back and look at this at some point. I'm sure there's going to be a terrific setup which is going to work really well, but the market will present it when the market's ready to do so. At the moment, it doesn't appear to be anywhere near ready.
Yeah. All right. Very good. Let's talking about stops. Actually, we've got another question here from Robert. Let's have a look at talking about. You moved from a percentage trailing stop to converting into an ATR based stop. Maybe you can just disclose why, and how much difference did you notice in your portfolio performance after implementing this strategy of stop losses?
I think it will. So for anyone who doesn't know, an ATR based stop, it's ATR stands for average true range. So it's measuring the trading range of a stock over the over a period of time. It might be over the last couple of weeks or the last month, whatever it may be. It would just add up all the trading ranges and go, okay, the trading range is 10 cents a day, and then you apply a multiple to that average, and that becomes the width of your trailing stop. So the trailing stop is going to be related to the volatility of the stock, as opposed to saying I'm going to have a 20% trailing stop loss, percentage based. So it could be a stock with it could be a low volatility stock or a high volatility stock. It's still 20%. Or the stock may be low volatility and then it goes through a volatile period, but it's still 20%. It doesn't order. Whereas the ATR stop, it's dynamic, so it's going to adjust as the price action adjusts. I think both are good. If the percentage one is easy to calculate, it's simpler for a lot of people to apply themselves. They can use brokers often. Some of the brokers might offer a trailing stop. So these are options that people can do, which are easy. But then I think the ATR one, I prefer that due to the dynamic nature of it, that it does adjust. I think it tailors the stop to the actual share price as opposed to just the generic percentage. If you're able to go to the extra level to calculate the ATR stop, I think it gives a better overall result. In terms of like how much better, I don't know. I don't have those. I'd have to do back testing and test out different scenarios, and then then it's like, are we talking? Then you got to like decide, okay, what percentage and ATRs are we comparing? Are we doing 10%, 15%, and 20%, and then we're going to do ATRs of 6, 10, and 12, or something like that, and sort of see. You can. These are the sort of back testing you can do to sort of see which strategies are going to work better, potentially over time. But I haven't really myself. I've never really been a percentage-based trailing stop trader. It's been ATR, or earlier in my career it was discretionary-based trailing stop, which is where I'd look for chart points and move a trailing stop up according to those. But I've never really been a fixed percentage trailing stop sort of guy.
All right, fantastic. Obviously, if you want to look at more videos around trailing stops, we've got a few in the previous series that we did, probably last year actually. If you look back at some of our first videos, we talked a lot about stop losses and things. So, and of course, you can always visit Jason over at his website. He has a lot of free information around the way he uses stop losses as well, right? So, all right, I don't think there's any other sort of general questions for now, which is good. Let's start having a look at some tickers here. Let's have a look at EBO, please, Jace. EBO.
Oh, EBO. So let's just have a look. So look, this is a stock which had done really well over several years, and it's been through a large consolidation or a large correction over the last couple of years. So it's interesting that just looking, you can see there was you can see this structural support area that came through around just above $31, broke down from there in June of this year. So a breakdown. So it was in a vulnerable position here. So lower levels, declining moving averages. But it didn't really get that follow through selling. It didn't continue into an ongoing spiral lower. Instead, it's turned around and it's broken back above the old support, which became resistance. So that, I like it. It's like, well, it's a false break. And so we're talking about false breaks in the ASX 200 earlier. That was a bullish break which failed. This is a bearish break which has failed. So I like it when you get these false breaks, because it shows that the market has the orders have come in to push the price past a threshold, being this support. It's broken down, but it hasn't got the follow through. So everyone who's wanted to sell, well, it appears they've already now sold out of this stock, and there's interest in buying it. Looking at the moving averages, it's gone from below the averages to above the moving averages are crossing. So I think this is a stock which is, I think it's an interesting situation. It probably could be bought at current levels. Stop could be just below the moving averages, just back below this previous support resistance, and it's got the potential to look new all-time highs. Is the potential. So it's asymmetric in terms of like, you can work out how much you risk versus potentially how much you could gain. And of course, it's could and potential, because I don't know, might never make a new all-time high again. I don't know. Nobody knows that. But we're just looking for, like, we're just trying to balance it to say, okay, I can see I've got considerable upside potential, and I'm limiting my downside. So if I keep taking setups like that time and time again, I'm going to get I'm probably going to get a percentage of them that work really well, and there are going to be others that don't, but I'll only have small losses. But when I'm right, I should make a lot. So that's the sort of mass you want when you're looking at these possibilities. So yeah, I think this is one worth considering.
All right, fantastic. What about JDO? JDO.
Interesting. Yeah, I spoke about this a few weeks ago in my weekly strategy session. I often talk about a couple of stocks which I've seen which look interesting, and I spoke about this one. And it's interesting to see that it's now having a breakout today. So this is why the trading range was already on there. So yeah, I like this one in that it's actually, I can't remember much about what they do. I think it's lending. It's a lending-based business. Actually, you've got to go and check the fundamentals out on your own, because I don't have my notes around that now. But yeah, so one of these stocks had been in a big decline. Then you can see the structure change from below the averages to above. Had a nice initial run, and then we've got this sideways compression back to the moving averages. Trades along the moving averages for several months. Forms up a new range, which we can see within this rectangle. Now we have a break to the top side. It's like we were talking about, like market filters and all this sort of thing. This is the sort of setup I'd consider be getting on now. So I want to de-risk a portfolio by getting out of some underperforming stocks, but being out of an underperformer and there's spare capital, and I've got a nice breakout like this. Well, this is something I can now consider. Do I want to now, rather than just sit in cash, do I want to look at an opportunity like this? I think this has got definite merit to it. It certainly has some nice upside potential, and the exit point is pretty clear cut for me. It would be just back within the range, maybe midway. It depends how aggressive you want to be with it. You could have one just near the top of the range or back towards the middle of the range around the 50-day moving average. But yeah, I think it's got some nice potential.
All right, fantastic. CU6, please.
So this has been a great trending stock back into the mid part of last year. So it's a motion trader stock. I've actually got this stock myself. I can't remember when I got in. It was it could have been around the December sort of phase. So it's up. I think my position's up something over 300%. So it's one of my strongest performers, and this is why we let profits run. When you're doing well, you don't want to cap your profits by taking small profits. So let profits run and see where they go. Wide trailing stop. Where does it go from here? I don't know where it goes. The underlying trend is still up. Nothing's changed there. The structure hasn't changed there. It's consolidating below a previous high. So like how does this play out from here? Like there could be some more sideways trade, and then it could break higher again. Could break higher now, or it could be finished its run. It's going to start to turn down, but I think the best we can do, as I was saying with the S&P 500, its benefit of the doubt goes to the incumbent trend, and that's the trend is up. So it's a stock I'd be happy to continue to have in my portfolio. Would I be buying? I'd find it harder to buy a stock like this here, even though the trend is up and it's trading along the moving averages, just given that it's up 300% within a year. It's a big gain. I tend to prefer to buy these stocks after they've had a larger consolidation. So one, I'd be happy to keep holding, but not necessarily wanting to be buying more of.
Yeah, that was a good one. I think I missed that one back at the late last year. It's all right, no worries.
And we don't get everything. There are so many different stocks that present opportunities that no one's going to get all the top performers. The best thing, I think, one of the great things about the momentum-based trend identification strategy, which I use as a trend follower, is that we use breakouts to identify stocks with this sort of potential early on. So this stock came on the radar back when it's probably had a couple of goes. So it probably met a buy criteria in November 22, rallied for a bit, then came back. So it wasn't ready. And then it gave would have given another signal back in August 23. But this time it got going. It rallied, came back to the averages, and then took off. And it's interesting just looking at the chart just here, like how many people would have seen this and gone, oh, look, this stock has doubled in a couple of months. I don't want it to come back. I better lock in my profits. But, this is why we don't lock in profits, because these things can run a lot further. So be patient with your profits and impatient with your losses. I think that's as a general principle, it's a good way to manage your portfolio.
Yeah. All right. AD8, please. I want to get off that chart, by the way.
Yeah. No, this is yeah. Well, there's a few things we can go through with this. So it's a case of like we've got good side of the chart where we got, we had it was a motion trader stock. Good side of the chart where you've got a stock which is trading along moving averages and breaking higher. This is where structurally, where it's a good structure. It's a bullish structure. We have rising price above rising moving averages. And then it's a case of letting profits run. We don't know where a trend is going to go, how far it will go. Then we have a situation where the structure starts to change. This is what we were talking about with the vulnerability with the S&P 500 or the ASX 200 in recent weeks. You don't know that the structure is going to change, but there's a vulnerability when price goes from highs to below moving averages. What's the rebound going to look like? What's going to happen with the moving averages? And in this case, you can see it stalls below the averages. The averages start to trend lower. So it's now a stock with vulnerability. Doesn't mean it can't stabilize, but it is a vulnerable situation, and that vulnerable situation gives way to a breakdown, and then the breakdown becomes a crash. So it's like why I say why I like to get out of vulnerable stocks. I don't want to hold in there, because this sort of stuff it can happen, and it does happen. It's not a stock I'm not a stock I want to do anything with at the moment. I wouldn't, if I had it, I would have already have cut it. I would have thought. If I hadn't got round to selling it and this happened, I'd probably be using the rebound towards the moving averages to just cut my position and move on. I think there's a lot of technical damage done now. This may well recover in the fullness of time, but it could take years. So if someone bought a position at higher levels and was stuck in it now and saying, "Oh, look, I'll just wait till I get back to break even," it could be a long time. Anything can happen. It could happen quickly, but chances are it'll take a while. So if I had it, I'd be selling into the rebound towards the averages and just moving on and going, okay, it hasn't worked. I'll just move on to the next opportunity. But the big lesson is just be careful when the structure changes and you go from trading above moving averages to consolidating below moving averages. This is when the bad stuff is most likely, where I think it's most likely to happen, when we're consolidating below moving averages and then we start to break down from a consolidation. Doesn't mean the trapdoor is going to open as it has in this case. It mightn't be that quick. It could just be like a continued grinding sell-off. Either way, it's not the situation you want to be in. So it's just this is what to look for in terms of like going, okay, is this still part of my trading plan to be holding this stock? So yeah, it's a good example to have a look at.
Okay, APX.
Yeah, I think we might have looked at Appen last week, and I think the problem last week was it was like, where do you put your stop? Did we look at it last week, or maybe we didn't?
I think we've looked at this stock a lot for our lesson on how things can turn around so quickly. If you look at how much it's down, up and down in the past, right? And now all of a sudden it's starting to show signs of life again, right? But
yeah, maybe I was asked about it on in my strategy session on Friday, and maybe I said then, like, yeah, it was like, so the difficulty with buying at current level, or even late last week, was like, where do you put your stop? You kind of got a stop, which is going to be a fair way below the market. So it becomes harder. Like it's great structure in that we've gone from below the averages to above. We had a bit of a consolidation while the moving averages were turning around, but then it really start to get going. If I was in this, I'd certainly be holding it. It is stretched above these moving averages at the moment. Let me just put an indicator on, which is interesting. It shows the percentage, what percentage a stock is away from its 50-day moving average. And we can see this one's getting up there. So, when you look across, Appen has rarely been this far above its 50-day moving average. What was that? That was 42. Because let me just go back. Where are we now? And we're 92. It's like, yeah, it's almost never been this high, this stretched above its moving averages. So that doesn't mean that it can't continue rising, but at some point the moving averages have to catch up. Now that gap could be narrowed by the moving averages really starting to lift and this just going sideways, or the stock could have a bit of a pause and come back. I don't know which one it's going to be, but this is why I'd be hesitant to buy it with it being stretched above the moving averages. I think the risk reward isn't ideal at the moment. But as I say, I'd be happy holding it. In terms of buying it, I'd probably want to wait for the next consolidation. Do we get another like sideways period back into the moving averages? That could take a while given where the averages are. But like I won't draw anything in because I don't know. So for me, it would be either hold or watch, depending on whether I'm in position or not.
Okay, CLX, please.
Yeah, look, you can see a trending phase. You can see what looks like a consolidation phase, and then maybe it's another trending phase possibly starting. So this is I think this is an interesting stock. I think it's a stock which has potential. And as I always say, we never know which setups are going to deliver the big gains. A stock which rises 500% could look very similar to a stock that peaks next week and goes straight down to its stop loss. They can have very similar structures going in. You don't know which one's going to deliver the big result. This is why we spread risk, and we had it's a portfolio. It's a portfolio of many relatively small trades rather than just a few big all or nothing bets. So yeah, look, this one's got potential. Whether it looks like it's a thinly traded stock, so that's something to bear in mind in terms of like whether this is the right sort of stock for you. A lot of these thinly traded stocks can just be hard to get in or out. Even with small parcels, they can still be hard. This one looks like it could be a more difficult one because all these dots you can see, these are days where it barely trades. So that's a consideration with this. It could you could get some consolidation while the averages catch up. But yeah, it'll be interesting. It's one which could well and truly see high levels.
All right, fantastic. Let's have a look at TLT, please.
So is this the I think this would be the US bond trust. Would that be right?
There's a few TLTs in there. Maybe you can, Francis, you can just give us a bit of clarity on that one. What about FPH? Well, we have a look.
If it is like TLT does come up in conversations, being it's a way, it's an ETF, and it's a way to trade off US bond interest rates, and we can do this through the Selfwealth platform. So it looks like this looks like potentially like a basing structure, in that we've had a rally off the low. It's kind of going sideways. So we're above the moving averages. Moving averages are moving higher. We could see this continue to rally. So if this were to rally, this means lower bond yields. So it's So this is bullish for bonds. If you're bullish bonds, it's suggesting lower yields. So it's an interesting play. For anyone who likes this sort of thing, exit point could be just below the 100-day moving average. So yeah, I think this is the area where we could see high levels for a bond ETF.
All right, FPH.
Uptrend in place. Look, uptrend's been in place for a while. This has been an ongoing move. Look, this would be a stock I'd be happy to continue holding. Broke above some resistance in May. This would be a stock which I wouldn't be in a hurry to buy, just with the current market situation, with the ASX 2% from an all-time high, looking like there's potential for some more swings within a larger range. I'm probably not in a hurry to buy a stock like FPH, which is also coming up to, there's going to be resistance at some point from this big consolidation area back in 2020, 21. I'd be happy to hold it with my trailing stop, but not in a hurry to go and initiate a new position at current levels in the current setting.
All right. CRYP, CRIP.
It doesn't trade very much, does it? It's
Gaps.
yeah. Look, this would be a well. It's a no at the moment because this is that's again back to that same structure we had for the ASX and S&P 500 from a high point to a low point quickly, and now what is the rebound going to look like? Moving averages are turning down; they haven't crossed yet, so the risk is that it does that, and we get the sideways consolidation. And once we get a structure like that, if the moving averages continue down, it opens the potential for a breakdown. So that's the risk. That's why I wouldn't be interested in buying the dip at the moment. Like what I just drew then, I'm not saying that's going to happen. That's pointing out that's what I'll look for. That's the vulnerability I'll look for. If this rallies quickly back up to above the 100-day moving averages, and we get price action that looks like that, well then it neutralizes the sell cycle, exactly like what we're talking about with the ASX and S&P 500. So I don't know. I'd be watching this one if I already owned it, and I owned it from way back when it was crossing moving averages a while ago. Where's your stop loss on it? And everyone's got to work out where their exit point is. So if I held it, if I was currently holding it, maybe I'd be watching how it rebounds. If we get that soft rebound, I'd probably be looking to unload it. If we get a bit of a vigor in the rebound, well then maybe I could use the recent low as my exit point. But I wouldn't be stepping up to buy it at this point. I want to see what does the rebound look like, and then assess from there.
Okay. All right. Jennifer says, Yale got dumped today, caught everyone off guard. Would you hold or get out?
Yeah, it just shows there's no sure things. There was no real sign of trouble with this one. It had just been consolidating back to the moving averages. And then so it's obviously like news related out of the company. So it's like, so first you go to your trading plan. Where's your exit point? Like, hopefully, like people have a predetermined exit point, because that takes a lot of the uncertainty away, because you go, okay, well, it's at my predetermined exit point, or it's gone through it, or it's above it, and then you know what to do. So if it's breached the exit point, well, okay, it's now time to leave the portfolio. If it's still got a bit more leeway, well, you can see whether it all settles down. Where's it currently trading? Like, we don't, and like it's hard with these things, because sometimes, so say it were to close at current levels. Sometimes we come in the next day and the market goes, well, okay, that was all a bit of an overreaction, and it opens a bit higher, and then I'll often sell that day. I'll often sell near the open, get a little bit better price. Sometimes the market comes in though and goes, well, that's actually pretty ordinary. It opens at a lower level, and then you're going, well, now what do I do? Do I sell here, or do I waiting for a rebound? It's a difficult situation. I can't tell anyone what to do, because I don't know what's going to happen. But if a stock has hit the point where you need to get out, for me, it's a case of, okay, I've got to manage that exit. It's how I manage the exit where there's uncertainty in terms of, do you go to market now, or do you try and finesse it? And it's probably a call everyone needs to make for themselves. I don't hold on to it, because there are going to be other opportunities out there. Technical damage is done. Not many stocks will have that big gap down and then be back at new highs a couple of months later. It's something's changed, and it probably takes time for the market to sort itself out, and then maybe turn itself around later on, or maybe not. I don't know. So I'd be inclined to say, look, I want to go and do other things now with that money. It's just what's my plan for getting myself out?
Yeah, exactly. That's what we talk about. Obviously, having that plan and being able to stick to it or veer off a little bit. Obviously, I was just having a look at the fundamentals as to why it's gapped down. You might want to have a look at that, Jennifer. I mean, have a look at the platform. Maybe that can help you as well with your decision around that. Not that we talk much about fundamentals, but it's interesting sometimes just to read why these things happen or why their potential happen. Right. So. All right. We've got a question from Robert here. Do you have an upper level of closing prices for your stocks of interest? Especially
sorry, Raj, just before we go on with that, just another example with this stock, in that, like, it had been trading at this is from earlier in the year, had been trading at highs, and then there was an announcement, gapped lower, and it did stabilize, but it didn't stabilize straight away. It got itself into a vulnerable place, didn't it? Look, consolidating below the moving averages. So it's like, when you've got a structure like that, it's like the right thing to do is I think the right thing to do is to say, look, it's not working. I'm getting out, because the risk is it keeps getting worse. Doesn't mean it will. Sometimes they turn around and recover, but, like, do you hold hoping that you're going to get that when you might get something much worse? So it's about managing risk, and seeing that. This is what I was saying earlier, and that sometimes it doesn't open higher, the market opens lower and then continues down. So yeah, look, I'm probably just adding some confusion to it now, but probably don't work on the basis that it's a quick recovery. Sorry, Rog, can you give me that question again?
I think sometimes you just want to help and you want to give as much information as possible, don't you? But unfortunately, you've got to make your own decision. Always do your own due diligence, right, around this. We can only just give you general guidance. All right. So, yeah, do you have an upper level of closing price for your stocks of interest, especially interest only in stocks below $10, $20, or $50? I'm assuming that's like a filter of the amount of the stocks you'd have.
So is that like the share price of a stock, whether it's a stock of interest? I'm only interested in stocks below $1 or above $10.
I believe that's the question. Yeah.
No, I don't really care what the price is. If it meets the criteria, I'm happy to have a look at it. That said, I'm not looking at stocks which are like under 10 cents. Because look, sometimes you get some really nice structures around a sub 10 cent stock, but there's also so much there that you don't want to look at. But look, if you can, I've got no problem. I've got no problem buying a stock which is below 10 cents if everything is right, or buying a stock which is $100 if everything is right. It's a lot of people think, oh, look, I'm not going to buy a $10 stock because I can't make as much money in it. I'd rather buy a $1 stock because if it goes up $1, I double my money. If a $10 stock goes up $1, I've only made 10%. I think that's the wrong way to look at it, because it's just a function of how many shares are on issue. So like the $10 stock could become a $1 stock by issuing a whole lot of new shares to shareholders. So everyone's value is the same. It's just a lower notional value for the share price. It's like what the company does and what interest there is in purchasing the shares, and think of it in percentages, not so much on the big numbers. I think that's the way to look at it. So yeah, the underlying price isn't really a factor for me.
All right, fantastic. Let's finish off on these two tickers then. We'll have a look at Zip, please.
Trend remains up. We looked at this a few times, and this is look, it's a nice it's been a nice structure. It's nice how it rallied, came back into the moving averages, rallied off those, breaking higher again, and continues to trend up. If I was holding, I'd keep holding it. it's like, do you buy it when it's stretched off the moving averages? It's not where I like to buy them. I like to buy them when they're rallying off their moving averages, when they compress into the moving averages and start to rally off it. That's like where I like buying stocks. Doesn't mean that buying it at current levels doesn't work. It's just not my preferred play. But it's interesting to see Zip come back to life after it got really sold down during 2021 into the early part of 22. Long period of doing nothing. That often happens when you get these big sell-offs. It just grinds along the bottom for ages. But now we've got this nicely structured turnaround underway. It'll be interesting where it goes.
All right, PM Gold, please.
What's the code for that?
I think it's PM Gold, isn't it? Or it might not be. Can we type in PM Gold? That's the one.
Oh, there we go.
It's not often with a big code like that, is it?
Well, that's it was gold, and that's basically Aussie gold. So what you can do? So what I'll do, like with this, so this looks patchy because it only trades in the local time zone. So it's there's several ways you can buy gold locally. So there's ETFs, the GOLD ETF. There's various other ones out there. So anyone interested in gold exposure, lots of ways to do it. It's the trend here is up. This is something I've been talking about in my weekly strategy sessions over the last few weeks, or last few months. In that we had that big rally earlier in the year, and then we've had the consolidation back to the moving averages, and we're now rallying off those averages again. Pausing to consolidate just here above the averages, but trends up. It looks like this will be making new highs. I think there's a strong possibility this will be making new highs in the next several weeks. It's a really nice upward trend in gold. Gold stocks are a bit more hit and miss. The most consistent trend, I think, has been in the metal itself, not so much in the individual stocks. So this is, I think this is I've got gold holdings, and I'm hanging on to them.
All right, fantastic. I think that's it for tickers for this week. Final question here: if you trade like this, do you trade in a personal account, sole trader account? I think that's up to you, seller. You can trade however you want on whichever account type you would like. There's no, that's a decision you have to make. Obviously,
it's an accountant question, that, because everyone's going to have different ways of their tax structures and things. So the accountants are best for like helping guide the best way to how to what name to have an account in, and all sorts of different ways to do it. And the accountants are pretty good at helping you understand them.
Yep, for sure. So check with your accountant, and you can open up all sorts of structures with Selfwealth. Having said that, so all those you could open up, right? So Kirby just says volatility is more important than share price. His sweet spot is the weekly ATR between 5 and 10%. I think that's related to your question, Robert. Remember, everyone has their plan. You create your plan. We're only here just to give you some of that general guidance from 30 years of wisdom from Jason. So thanks a lot for all that again, Jace. Much appreciated. Don't forget to go and visit him over at motiontrader.com.au. Come and visit me at selfwealth.com.au and say hello and ask any of your questions, and we'll have them answered next week in Tuesday's show at 12 o'clock once again. All right. And don't forget to hit like, subscribe, and comment and all that sort of great stuff as well. Thanks, Jace.
Thanks, Rog. That's got through a lot today. Hopefully it's been interesting and given everyone a few ideas. Hopefully it's been helpful.
Have a great week, everyone, and you too, Jason. And hopefully you're fully recovered by next week. And that's all I'm hoping for. All right. Take care, everyone.
Thanks, Rog. Thanks, everyone.